Hi, and welcome to this Premier Training revision video which looks at the techniques involved in flexing a budget. So, what is a budget? A budget is simply a financial plan, prepared in advance and based on a wide range of predetermined costs and revenues. So it provides a business with a picture or forecast of what it expects to happen. But what sort of information is needed to create a budget? Well, potentially quite a lot. If we were to prepare a budget for a manufacturing business, forecasts will need to be made about the number of units that need producing, and how much revenue is expected in the period, how much material we're going to need, and what those materials are going to cost, and what wastage there might be in the production process. And we'll also need to know how much labour is going to be needed, and at what cost, or if we're going to need to factor in any overtime. And we'll also need to have a realistic estimate of the overheads expected for the period. So there's certainly a lot to consider, and this list isn't even exhaustive. The information needed will vary depending on the needs of the budget. Okay, this is all great, but why is creating a budget useful at all? Well, budgets help with planning, that is, planning the production of goods and services for the next accounting period, and deciding what resources are required and ensuring they'll be available at the right time. Communication and coordination. Budgets help ensure the business as a whole is working towards the same aims and objectives. And once a budget is agreed, it can also be used to authorise a certain course of action, such as agreed spending limits or delegating decision making. And budgets can also be used to monitor and control. Checks can be carried out on a regular basis to identify and investigate cost and revenue variances from the budget, and help the business make pricing decisions, or consider the effect on costs of using different qualities of materials or levels of skilled labour. And budgets can also help organisations control their expenditure by setting targets and holding different areas of the business accountable for their performance. And finally, budgets can help motivate. A realistic but challenging budget, possibly attached to rewards or incentives, will encourage individual managers to work hard to achieve their targets, which of course will benefit the organisation as a whole. So a budget provides a clear set of targets which should ensure the business is able to achieve its goals. And this is clearly a useful process for any business to go through. However, because the budget is based on forecasts, it's rarely, if ever, going to prove entirely accurate. And problems can occur if the level of activity is significantly different from which was originally planned. Let's see why. Imagine you were hosting a party, and you decided that you'd order pizza in for everyone who came. And let's say you expect, or rather forecast, that 10 people would turn up, and that you budgeted that you'd need to spend £5 per guest on pizza, which would result in a total pizza budget for the party of £50. On the night of the party, 20 people actually turn up, and it's extremely unlikely that you'll be able to meet your £50 target, as this was based on 10 people attending, and you're definitely going to need more pizza. But at the end of the party, you find that you've actually spent £80 on pizza for your 20 guests. On the face of it, this doesn't look very good, as you've clearly overspent against your original budget for the party by some £30. But it's not really a fair comparison, and you could, justifiably, be quite pleased. Based on your original budget of £5 per person, you would have expected 20 guests to have cost you £100. But because you ended up spending just £4 per person, the actual cost came in lower than expected. So you could even argue that you saved money against the original plan. £20 in fact. And what we did in this step was that we flexed the original budget so that we were comparing like with like. That is, changing the number of guests in our original budget to match the actual number of guests that turned up. Unfortunately, the party's over and it's back to work. Aww. So let's look at how a flexed budget might work in a manufacturing business rather than a party. JJ Limited has produced a budget for the fourth quarter of the year, as shown here. There's a couple of things to note straight away. Firstly, this is a budget prepared for a quarter or 3 months. And secondly, it's based on a forecast production level of 2,000 units. Following the end of this quarter, we received the following actual results. And on the face of it, it looks to have been a successful quarter. Sales were higher, and so too was the net profit, compared to the forecasts in the budget. And we can use these actual figures to produce some variances. The variances here are simply the difference between the actual figure and the budget. And each variance is stated as either favourable, where we earned more or spent less than forecast, or adverse, where we earned less or spent more than forecast. As an example, we can see here that the sales variance is favourable because we earned more from sales than budgeted, and that the materials variance is adverse because we spent more on materials than expected. And this kind of information is very useful to managers. However, these variances are only valid if the actual level of activity is the same as that used in the original budget. And we now learn that in actual fact, we produced 2,300 units in this quarter, and not the planned 2,000 units the original budget was based upon. And as we've just said, to make any comparison valid, we need to compare like with like. We can't change the actual figures, as that's what's actually happened. So instead, we need to flex the budget, that is, rewrite it, to create what it would have looked like had it been based on the actual production level of 2,300 units. So this is a little like the example we looked at earlier, when we were ordering pizza for our party. Had we known that 20 people were going to turn up, we'd have produced a different budget based on the actual number of guests. So, we need to scrap these variances and start again. And this time, let's add in a column for our flexed budget. Here's the original budget again for JJ Limited, along with the same actual activity level for the fourth quarter, which we now know to be for 2,300 units. But this time we have some additional information on how the different costs behave. As when flexing a budget, we need to know whether each cost is variable, fixed, semi-variable or stepped. So let's get started. First up is sales. Sales were budgeted to be £80,000 for 2,000 units. Therefore, each unit was expected to sell for £80,000 divided by 2,000 units, which is £40 per unit. 2,300 units at £40 each would therefore have been expected to raise £92,000 in sales. Next is materials, and we're told that materials are 100% variable. So the original budget of £20,000 for 2,000 units means that we forecast materials to be £10 per unit. So the cost of materials for 2,300 units at £10 per unit would be £23,000. Labour costs here are a little more complicated. We're told that each full-time worker can produce a maximum of 500 units each per quarter. So, to produce the original budget of 2,000 units, we would have needed 4 workers. That is, 2,000 units divided by 500 units each. So, to produce 2,300 units, we're going to need an additional full-time worker, which will allow the business to produce up to 2,500 units. And this means that labour here is a stepped cost. But we're also told that each worker is paid £2,000 per month. But remember, the budget is for a quarter, so the flexed budget will be calculated as 5 workers multiplied by £2,000 multiplied by 3 months, which is £30,000. Production overheads are a fixed cost, and fixed costs don't change with the level of activity. So we would have budgeted for £6,000 whether we'd based the budget on 2,000 units or 2,300 units. Now we can recalculate the budgeted gross profit by deducting the costs from the sales. And this gives a slightly higher budgeted gross profit figure of £33,000 based on 2,300 units. Now for general expenses, which we're told has a fixed and variable element to it. That is, it's a semi-variable cost. To be able to flex this expense, we need to first find the variable cost per unit. General expenses in our original budget was £16,000. And if we deduct the fixed element of £10,000 and divide the results by 2,000 units, we see that the variable cost per unit is £3. So, general expenses in the flexed budget will consist of the fixed element of £10,000 plus 2,300 units multiplied by £3, which gives a result of £16,900. And finally, we can recalculate the budgeted net profit, which is the gross profit less the general expenses, giving us a figure of £16,100. And this completes the flexed budget, flexed to reflect an increase in activity from the original budget of 2,000 units to the actual level of activity of 2,300 units. OK, now that's done, we can recalculate the variances. As before, each variance is shown as either favourable or adverse. But this time we've calculated the difference between the actual costs and the new flexed budget. Let's compare this with the original variances we calculated before we flexed the budget. Initially, we compared the actual results to a budget with a completely different level of activity, which gave the impression that the business had performed well over the period. But now we can see that this wasn't a fair comparison, as when we adjust or flex the budget for the same level of activity, it gives a completely different picture of how the business has performed. So you can see how that flexing a budget gives a much fairer or realistic picture of what's happened. And the reason it's more realistic is because it's a more like-for-like comparison. I hope you found this video helpful, and thanks for watching. Anyone for pizza?